we're back live again. So all for you FR students today, and SBR really, there's IFRS 15 in SBR as well. I hope you are all well and looking forward to it. It will be about 10 to 15 minutes of your time, and hopefully you'll know a lot more about IFRS 15 at the end. Any questions at all, do ask in the chat box. We're here to help. And it all leads for me now to crack on with it, I think. Okay, so IFRS 15. Step number 1, you need to have a contract with a customer. Step number 2, you need to have an obligation to your customer. That's why they're a customer. Step number 3, you need to have a price of what you're selling. Step number 4, you need to allocate the price to what it is you're selling. And number 5, you've got to satisfy your obligation, and then you can recognize the revenue. Now, obviously, the 5-step approach is really good for getting marks because you can work your way through it. However, lots of the questions maybe look at step 4 or step 5 on their own, that sort of thing. But anyway, let's go through these in more detail. Let's say that makes sense. First of all, identify the contract. So you and the customer, you must both approve it. It doesn't have to be in writing or anything like that. It could just be in the way that you act. So you've approved it. You need to know what the rights and terms are. They've been identified. That it commercially has substance, and this is the one that's going to cause most of the problems, that it's got probable consideration. So the question is, well, what if it doesn't have probable consideration? Well, you've received some cash, so you're going to debit cash and credit liability instead of crediting revenue, because you're probably not going to receive it because you haven't got probable consideration. You're probably going to have to pay it back, so therefore credit liability. But don't worry about that too much just yet. So here's an illustration of what I mean. You sell an asset for $1 million. That's your contract. But you've received 10,000. Okay. And the remainder is payable over 3 years. Now, if the customer defaults on the remainder, then the goods are returned and we get no compensation. So the customer that we're talking about here is in a highly competitive industry, and they're going to use income generated to repay the remainder, but they have no other assets and no other income, okay? And they've got no experience in the industry, so we're not sure if that consideration is probable. So there's two parties approving everything. The probable bit that we've got the problem with because they've got no experience. So the 10,000 would be a liability. Moving on. Identify an obligation. This is where it gets a bit more interesting. So here's a contract for 2 goods, 2 services, 3 goods and 2 services. So the obligations are each individual one. So you've got an obligation for number 1, an obligation for good number 2, and an obligation is basically a promise to transfer. So if they've paid for a book, it's the promise to transfer a book. So normally your obligation is to give them a book or whatever it is you're transferring. But that transfer, that promise needs to be distinct. So by distinct, we mean it's identifiable and separately identifiable, like a book, or customer can benefit from it on its own, like a book. So normally you just say, well, it's easy. Identify your obligation, identify your promise, and that's straightforward. But what if it's not distinct? Well, you combine it with other things until that thing as a whole becomes distinct. So you bundle it together, like bundling those 3 together there so that they make a distinct promise to transfer, and you deal with it as a whole. So it needs to be distinct. Now you might be thinking, not too sure what you mean about that. So have a look at this. You've got a bus without an engine and an engine. Well, both of those, they're not on their own, are they? Customer can't benefit from a bus without the engine and an engine on its own. They both need to go together. So you would bundle the 2 up. You've actually just got one obligation, the bus without the engine and the engine, okay? And that's what you're promising to transfer. So we've identified the contract, we identify our obligations, and the obligations need to be distinct. Now we're going to determine what price. If you go to Amazon and you pay £10 for a book, the price is £10. It's the amount that you expect to receive. And Amazon would put a sale in for £10 because that's what they expect to receive. But what if it's non-cash? Well, put in the fair value of that non-cash. But what if it's variable consideration? Maybe you might receive 100 or you might receive 120, depending on conditions. Well, you need to see which condition is more likely, don't you? And we'll look into that in a bit. Take off any payments to customer and significant financing. Don't worry about that. It's the variable consideration that I want to look at in this lunchtime live. So if there's a few outcomes or very similar contracts, then you'll take the most likely outcome because you want the price that you expect to receive. If there's many possible different outcomes, then just do an expected value. So if there's a few outcomes, it's the most likely. If there's many different outcomes, an expected value. And when we say about different outcomes, we say, look, I might have to pay 100, 101, 102, 103, 104, 100 and whatever, lots of different outcomes. Or is there just maybe two outcomes? If there's just two outcomes, choose the most likely. If there's lots of different outcomes, then do an expected value. So what about this one? You sell a product for $100 per unit, and the bulk purchase discount of $10 if orders are more than 1,000 units a year. Okay, well, the orders expected are 800. So what is the most likely? Will we receive 100 or will we have to pay a discount, give a discount? We won't have to give a discount because their expected orders are 800 instead of more than 1,000. So we'd put in the full price. How would that change if we know that we expect 1,100 units to be sold? Well, in which case then we know we're going to have to probably give a discount, so we recognize revenue to begin with at the 90 instead of the 100. All okay with that? Everybody still with me? So we've got to apply that retrospectively, so you might not have known that your orders were going to be over 1,000. As soon as they do reach over 1,000, you go back and change your sales to $90. Okay, this is where it gets a bit trickier. So this step is only needed if you've got multiple obligations. And if you remember, an obligation was a promise to transfer. So if you're selling lots of things, often as a bundle, and you need to use what we call standalone selling prices. Sounds harder than it really is. So we are selling something for 280. There's multiple things in that 280. And that multiple is two. There's two obligations, two promises to transfer. And we're going to use the standard standalone price. Obligation 1 is 100 and obligation 2 is 200. But we're selling them as a bundle for not 300, but for a discounted 280. So how are you going to deal with that? How are you going to allocate the 100 and the 200 into 280? Well, the 100 is 1/3, isn't it? So it gets 1/3 of the 280, and the 200 is 2/3 of the 300. So times that by 280, and there you go. You've now allocated 93 to promise obligation number 1, 187 to obligation number 2. Okay, and that's what you'll put into revenue. So you debit cash 280, credit sales when you sell obligation 1 with 93, credit sales with obligation number 2 when you sell it, when you transfer it at 187. So that brings us to the final bit then. When do you actually recognize the revenue? Well, if you are doing something over time, over 5 years, you'd recognize the revenue over 5 years. If you are doing your obligation at one moment in time, you would recognize the revenue at one moment in time. Kind of makes sense. So if it's over time, let's say you're doing something over 5 years and you're 3 years through, then you can put in 3 years worth of revenue over the 3 years. If it's at one moment in time, well, as soon as you've transferred, as soon as you've done your obligation and control has been transferred, you can bring in the revenue. So if you're selling a book, as soon as you post the book off, so as soon as they've got control of it. So if you perform a service over 2 years, that's obviously over time. And that's often when the customer consumes it as we perform it. So a maintenance contract or something like that. What about this one? Getting a bit tricky now. We make a specialized asset for a customer. They paid us a deposit, but they pay us the rest on delivery. So you might think, is that over time? Because we're building it over time, we're making it over time, but the control's transferred at one moment in time, isn't it? So the rules are, if it's a specialized asset, you can treat it over time, you can recognize the revenue over time, but only if you've got a right to be paid over time for performance to date. If you haven't, then it's at one time as opposed to over time. So it'd be at one time there. Okay, these are the things to think about. Is it over time at one time? If the customer assumes it as we perform it, then it's probably over time. If it's a specialized asset with an enforceable right, it's probably over time. If the customer controls it as we build it, it's probably over time. Finally, when is it at one time then? Well, the thing you look for is when control has been transferred. So do you have the present right to payment? If you have a right to payment, you've probably your obligation, haven't you? So at one time. When the customer has the legal title, then you've probably transferred control. These are only indicators, by the way. If you've transferred the asset, you've sold the book, you've given it to them, then that's probably at one time as well, isn't it? And the customer takes on the risks and rewards. Basically, you've transferred control. Okay, so that's basically everything that I wanted to go through, and I just want to recap it all. So, whoops. To recap it all then, what we then was a contract. We had to identify the contract, and if you remember, when we identified the contract, everyone needs to know their rights, everyone needs to agree, even if it's just by the way you act, and the consideration needs to be probable. Then you identify your obligations. Well, what are my obligations? Have I got 5 of them? Are they all distinct? Now, distinct means, are they useful to the customer on their own? Can the customer benefit from it on their own? If they can, fantastic, that's your obligation. If not, then bundle it up with other things that will make that obligation. Then step 3, you determine the price, and the price is the key that you need to remember is what's the expected amount. Okay, do you expect more or less? So if it's a variable payment, you're going to look for things like, are there small number of outcomes or big number of outcomes? Small number of outcomes, remember we choose the most likely. Big number of outcomes, we choose an expected value. Then we come to allocate the price. So if you've got, remember we had $300, and that's what their standalone prices were worth, 100 and 200 coming to 300, but we sold it as a bargain for 280, then the 100 gets 1/3 because it was 100 out of the 300 standalone prices. It got 1/3 of the 280. The 200 got 2/3 of the 280. So you've allocated the price. Then finally, once you know the price and everything, well, now you need to recognize the revenue. And you just need to be careful. If it's something over time, you recognize the revenue over time. If it's something at one time, you recognize the revenue at one time when the control has been transferred. Well, when has control been transferred? When we've got a right to be paid, when the customer has the legal title, when the assets are transferred, and when the customer has the risks and rewards. That's basically it, my friends. I hope you enjoyed that 14 minutes and 30 seconds. So all that there's left for me now is to wish you all well for the rest of the afternoon, and do keep in touch while we're any questions or anything you want me to go through, because I'm willing to go through anything on any paper. I'll do it for you. We'll do it over lunchtime live. It will be 15 minutes and hopefully enjoy it. Okay, so thanks very much and take care.